Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The main immediate pattern here since September 2024 had been, and might just still about be, after a fashion, the September-December 2024 bear channel, currently at 1836 to 2022, highlighted in dark blue on my daily chart. This pattern achieved its primary target mid-January and its secondary harder to reach target about a week after the primary target. Interestingly, the move down to the secondary target and back up again has formed another new pattern, and I'll discuss this shortly. However, before that, I'd like to highlight again another larger, longer term pattern, and that is just about, though it has been breached again, just about breached last Friday, the November 2023 to September 2024 bearish Andrews pitchfork, highlighted in purple on my daily chart. This pattern, as I said, was breached last Friday, and the recent action, especially since mid-December last year, has revealed another new pattern that has been breached simultaneously with the upper tine. This is the one I spoke about earlier. Originally I saw it as a simple V-bottom formed over January, but one that unusually has a handle or extension before the formation of the V-bottom in mid-January. It might also have very well a handle or extension after it as well, formed or forming over last week. Now, I said 2 weeks ago about this pattern, and I quote, "This is a possible latent reverse head and shoulder pattern, but one that is not well defined, hence not worthy of the name of a reverse head and shoulders pattern." End of quote. Well, since then, this pattern has matured, and we do indeed have a real reverse head and shoulders bottom with a bright green neckline, which is currently at 2025. As you can see from the daily chart, Friday saw a break up and close over both the purple upper tine and the bright red neckline at the same time, at the same level. I can indicate some potentials now topside for such a pattern break. Thus, an initial potential would be possibly as high as 2205 and a secondary potential up in the 2275 area. So what have we in the way overhead that might stop this happening? Well, we have two congestion. We've not confirmed this pattern on the upside, I should say. We're still waiting for that. It's just a break at the moment. But we have two congestion areas overhead. The first is between, on the wide, 2010 to 21 even, and originates from January to February 2017. In there we have the slowly declining mauve medium moving average, currently at 2083, and the two-pointer downtrend from late September last year, currently at 2090. To be honest, my initial thoughts were that this congestion was not necessarily that strong, but upon closer inspection, especially the action over late December 2024 to early January 2025, it looks like it might have some pedigree, so please be aware. Now, further up, we have more resistance from the 2140 to 2148 congestion, consisting of the 50% Fibonacci line of the March 21 to October 2023 move and the November 2017 high. This does not look that prominent as a resistance. Just in case we do move lower, look to the flatlining long moving average, currently at 1997, and the broken, potentially still influential August 2022 to date uptrend, currently at 1955. It's broken, but we'll leave it as that for the moment. Ice Europe, white sugar in London. There are at least 5 features to bear in mind here, at least. The first is the obvious late September to date descending expanding wedge pattern, currently 436.40 to 545.70, highlighted in purple on my daily chart. This pattern has more than the requisite 5 touches, but is being severely tested right now on the top side. The second is the January 2024 to date downtrend, currently at 560.5. right now above the market and highlighted in bright red on my daily chart. It has effectively capped any rises since its start. Now, the third is the April to June 2021 head and shoulders neckline. It's below the market, currently at 487.10. This has been breached, but it seemingly still has some resilience, and the mid-January rise, well, this uptrend has been one of the influences that turned prices higher. Fourth, the slowly declining green short medium moving average, currently at 517.10. This had capped prices in the past and is now a potential zone of support for the very recent move higher. Further up now we have the mauve medium moving average, 538.20, and the nearby long moving average, currently at 542.5, gold long moving average. And this was the start of resistances ahead of the upper trend line, currently 545.70, of the purple highlighted descending expanding wedge pattern. That is a little higher up. The fifth is the most recent market pattern here. Originally this was the mid-December 2024 to date V bottom that unusually had an extension before the formation of the V bottom itself back in mid to late January. However, the action over the last 2 weeks has created what looks like a mid-December to date, very imperfect, I hasten to say that again, very imperfect reverse head and shoulders bottom, something that ties in with the New York sugar futures. The proposed neckline is highlighted in bright green on my daily chart and is currently at 514.90. Okay, so those are the main features of this market. What have we got going on now? Well, a number of these features, the mauve medium moving average, the gold long moving average, the bright green neckline and the purple upper trend line, have and still are being tested right now. Which with changeover is how we also ended up with the single session island pattern below last Thursday. The market has not stabilized over these all, not yet, but it is trying to do so. But I'm mindful of the congestion overhead formed between mid-September to mid-December last year, roughly between 545 to 565, and then again between 558.5 to 585. Two overlapping in some ways congestion, if you think about it, that look quite formidable. However, if the reverse head and shoulders bottom does start stimulating the bullish incentive, then whilst we have no targets as yet, topside, we can have some potentials. Thus the primary potential will be up in the 585.80 area, so this is depending on it being confirmed or break upwards. So it's 585.80 area for secondary harder to reach potential up in the 604.20 area. If we look at the resistance as topside, well, the two bands of congestion previously mentioned, they would impinge on the market. But I would also add the congestion area between 589.90 and 592.80, containing the 50% Fibonacci line for the July 2021 to November 2023 move as an impactful area overhead on any significant rise, and even the neckline extension above to the late May-August 2023 reverse head and shoulders bottom, currently at 610.80. Though I am more inclined to look at this neckline when it has decreased a bit further. Overall, the features to watch out for are the purple descending wedge pattern, the medium and long moving averages that are just below, the bright green reverse head and shoulders and neckline further below, and the bright red downtrend that's above. Sugar white premium spread. After 41 weeks of discussing the same pattern more or less in different ways, last week saw a confirmation of the break up and out of what was originally a descending wedge pattern that developed into a big bear channel. This event was always on the cards, with the market hesitating for an extended period between late September last year and late January this year. At the important purple neckline extension to the significant February to September 2020 head and shoulders top, currently at 77 even. After various attempts lower over Q4 2024, last week the market turned and broke higher, closing over the upper downtrend of the bear channel, currently at 75 3/4, 3 weeks ago, and finally justifying the move higher last week with a huge weekly combined key reversal up and bullish closing long white Mariposa. Last week's close was the first close over the gold long moving average, currently at 112.12. It's also filled in that gap that was left over back in Q3. And that's actually the first close over the gold long moving average since late June last year. And that close was actually an aberration. You'd have to look to March and April for the last time the market has properly closed over the gold long moving average. Anyway, we've had a break higher so that we can have as potentials, some potentials topside for this move, if not actual targets. Well, the immediate potential target X is up in the 137.5 area, which is still some way up. We have a secondary, harder to reach target up in the 154.5 area. Are these possible? Well, yes, but we have a congestion area overhead between 128.75 up to 153 even, which will make target X perhaps hard and target X1 further up just that much more difficult.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.